Hello, welcome. How's it going? My name is Rob Reinhold, and this is the levered ETF series that we're doing here at Maverick, where we're going through all the levered ETFs and talking about the positives and the negatives. And before we can really just jump into the levered ETFs, I want to take just a second and go through just what a regular ETF works, how it works for those of you that don't know exactly what it is. Whenever you hear the term the stock market, that really doesn't mean anything. Look, there's several different exchanges where stocks are bought and sold on a daily basis and they go up and down. There's really no way to say, hey, how are all the stocks doing? And so they created these things called indexes that you could actually track what the market was doing, like the Dow Jones Industrial Average, the Standard & Poor's 500, the Russell 2000. And they created these as a way for someone to look at this number and say, oh, the market went up today, the market went down today, but it was just a collection of those 500 stocks that they put in there. In 1993, a firm called State Street created the first exchange-traded fund called the SPY, or as was called the Spiders. This was developed to deliver the same return as the S&P 500 index. The great thing about these is it was a stock. It wasn't a mutual fund. It wasn't index. It could be directly bought and sold like a stock at any time at a really cheap price. This was a great alternative to mutual funds. Before ETFs, if you wanted to get the same return as the market, you had to pay a company probably somewhere around 0.5% or 1% to run the money to try to get you the same return. Now it's as easy as just buying SPY. And these have options, which is awesome. We're an options trading firm at Maverick, so we absolutely love options on these ETFs. Before we jump into the TQs, we really have to cover the Qs. Okay, so here are the Qs. It's the NASDAQ 100. Now, to understand how these ETFs are put together, there is a company that runs each ETF. And it's actually become a big business for them because they get to collect fees and all the other stuff that comes along with it. So years ago, they created the NASDAQ 100. Now, there is an index called the NASDAQ 100. It follows 100 of the largest tech and biotech companies out there traded on the NASDAQ exchange. And basically, you can use this NASDAQ 100 index to say, oh, this is how these large cap tech stocks are doing. They created the Qs. Now you don't have to look at the index. Now that you can actually directly buy the Qs. Now, the difference about the Qs than the TQs is that the Qs hold real positions in the stock. So every time money comes in and out of the Qs, the company that manages it is constantly in there buying and selling shares in all of the 100 underlying. ETFs have become very, very important because this is how the market is moving. It's estimated that 40% of all stock volume is due to ETFs alone. It's just a really big deal, these ETFs. And as you can see, it is a weighted portfolio. So it says there the Apple is 12 times more important, more weighted than the average stock. And then you can see the small ones like NetEase down there, barely is a fraction of the return. We just looked at the Qs and saw that they were going to return what the NASDAQ 100 did. But let's say someone says, hey, you know what? I want to take that and magnify it. I want to take those Qs and times it by 3. So if you take the Qs and you times it by 3, you get the TQ. So that's exactly what we're going to be trading when we trade the TQ. The TQ is the 3X NASDAQ 100 run by ProShares. It's called the UltraPro QQQ, but everyone just calls it the TQs. And you can see it's going to move just like the Qs did, but it's going to move 3 times as much to the upside and to the downside. One of the things to really understand about this, we're going to get into some of the risks of these levered ETFs, is that these levered ETFs do not contain any stock. Well, I shouldn't say any. They might have a little bit. But the firms that run these programs, they're using options, futures, and leverage to try to make up for the performance return of the Qs. It makes it to where it's not a perfect match all the time because lots of things can change in options and futures that causes what we call a differential. I wanted to sit here and show you a side-by-side comparison. On the left is the Qs. On the right, we've got the TQs. And you can see they're going to move the same, except one is going to move at an amplitude of 3 times more. So every time those Qs go up 1%, the TQs go up 3%. And every time the Qs go down 2%, the TQs go down 6%. Same thing, same candles, but you can see just a little bit more amplitude to everything. So let's take a look at a trader is looking at, okay, I'm going to buy some stock. And they say, I'm looking at the Qs, I'm going to buy $10,000 worth of Qs. That's the price. That would buy you 30.4 shares. Another trader says, hey, I want to buy $10,000 worth of the TQs. Here's the price, and now I own 233.2 shares of the TQs. This is where people kind of get it mixed up, is that these are both $10,000 positions. They're both $10,000 positions. The shares don't really matter. We are long $10,000 worth of the Qs or the TQs. So let's take a look at margin here, and let's really talk about rates of return. Pulled this directly off of Interactive Brokers. All of our traders trade through Interactive Brokers. It's the best, and they all trade with what's called portfolio margin. So if you take a look at this trade, this is a trade for $10,000 worth of the Qs. So we got $10,000 worth of Qs, and it says it's going to cost you $1,100 in margin. So that is what is being tied up in your account for you to trade $10,000 worth of the Qs. So let's say the Qs go up 10%. This is really easy math. We've got a $10,000 investment that went up 10%. That's a $1,000 profit. And what we had locked up in the trade was $1,100 in margin. That's a 91% return on margin. If we take a look at the TQs, same thing. We've got $10,000 worth of the TQs. The margin on this one, $3,200. Let's say this TQ goes up 30%, because again, 3 times the return. That's a $3,000 profit divided by what we had in margin. And you can see the trade is virtually identical. Hopefully you're starting to see now that, again, there's a lot of similarities. So the question is, why are people trading the Qs? Why should you trade the Qs? And what are the risks that no one is really talking about? And that's really where I want to start here, is the risks. We all see the upside. It's wonderful when instead of making 10%, you make 30%. But let's talk about the negatives. When you get into the world of levered ETFs, you really need to understand the return differential. Now remember, levered ETFs don't hold any stock. They hold options and futures and derivatives. And they're trying to match the closest they can to the return of the Qs as they possibly can. Sometimes that doesn't always go right. So take a look at 2020. 2020 was the worst year for the TQs. Now people are going to look at that and say, Rob, are you crazy? It went up 110%. How could that be the worst? If that's the worst, then sign me up. That's fantastic. Well, here's the problem. The regular Qs went up 48%. Times that by 3, that should have been around 150%. So here is the history of the TQs. And we don't have anything past 2010 because they were created in 2011. But take a look at that first year. The Qs went up 3.44%. And the TQs went down. Many people that dive into the world of levered ETFs don't even understand that can happen. They didn't even know. It absolutely can happen. Now, look, there's going to be some years where maybe you do a little bit better, but take a look at 2018. 2018 was a disaster of a year. The Qs went down 0.1%. The TQs went down 20%. So when you take a look at the differentials here, and we talked about, when you look at returns and you look at, and you look at taking the same amount of risk on the Qs as the TQs, it's the same percentage returns. All of a sudden, you can see that if you were to trade the TQs, you would substantially underperform. And you can see in 2020, you underperformed by 35%. In 2018, you underperformed by 19%. Now, yes, some years you got a beneficial outcome. 2013, it was much better to be in the TQs. But remember, what helps you on the upside is going to hurt you on the downside. I tell everyone, if you expect a 10% return and you own the TQs per year, then you should expect to get about 25 to 27% a year on the TQs. People say, Rob, I want 30. Well, you don't get it. And here's what you also have to accept. On the years where the market goes down 10%, those TQs are likely going to be down 33, 34%. So there is always a drag. And this is where, if any of you have researched these, people say it's really not good for long-term holding because this differential is almost always working against you. So that is just the biggest thing about these levered ETFs. Now, look, if you understand that, then you can really trade these a lot easier without all these risks. They do come with higher fees. So every ETF company charges a management fee. You can see the Qs are at 0.2. All the levered ETFs are just under 1%. Every time you trade these, they are going to ding you some of those fees. That is going to come out of your account for sure. And the other thing that is really, really sad is that there's really no benefit to trading options on the levered ETFs. Now, people say, Rob, how can you say that? Because look at the Qs. They're only going to go up a little bit. But if I buy the TQs, they're going to go up a lot. Yes, I know that you know that. I know that. And guess what? The market knows it. And the Black-Scholes formula knows it. So what's going to happen is they are going to make all of the options 3 times more expensive to buy the options on the TQ. When you take a look at very similar strategies, both on the Qs and the TQs, and you put them in and you see the risk return, you go look at your risk graph, they're going to be virtually identical. The problem is that the Qs is going to be much cheaper to trade because you have 1 penny spreads on the bid-ask spread, where on the TQ, you're going to have 20 to 30 cent spreads. And that is money coming directly out of your pocket. So the sad thing is, again, I'm an options trader. I love options, but there's just really no reason at all for me to trade options on these levered ETFs. And let's get into the number one risk of levered options, position sizing. If you would have been holding the TQs in 2008, now I know that's dramatic, but 2008, you would have lost 85, 90% of your money. It would have been gone. If you had your whole account in there, it'd be gone. Going into COVID. And I remember before COVID even hit, oil and gas tumbled 60% in January, February, March. Times that by 3. If you have too big of a position size, it will absolutely crush you. And in Maverick, we talk about risk management. We talk about never putting yourself in a situation where you can have a greater than 10% drawdown. I mean, and 10% is just way too much, but that is like the bare minimum. Controlling your risk and your exposure is the only control you have as a trader. So you can play these levered ETFs, but you need to understand, okay, how do I play them and how do I trade them safely here? So let's talk exactly about that. Let's talk about intraday trading. This is probably the best use of them. Just to go straight long the TQ. We'll talk about the SQ in another video, but you just get in and out in the same day. This is super clean. The differential is going to be negligible. Negligible. The spreads are tight. Everything is good. So this is probably the best use for trading and like trying to be a directional trader and trading direction. Let's talk about people that are swing traders. Most of my trades last between 2 to 3 weeks in options. So this is really what I'm looking for. But like I said, it doesn't make any sense to trade options on these. So for anyone looking to trade just straight stock, I could see a swing trade being an acceptable use. You know, anywhere from 2 to 10 days, you are going to get hit with a little differential. You might get a little bit extra, but it's really not going to hurt you long term over time. The best way to use it is hedging, and I use it a lot this way. So let's talk about hedging and how we can use these to hedge out some of our current positions. Here's an example of a time where using the levered 3x NASDAQ would be a great time to hedge out a position. So let's say you're a trader and you were already short and you're short tech stocks and the market's been going down, but all of a sudden the market starts to rebound sharply. You don't quite want to get out of your positions yet, but you definitely think it's going to go a little bit more against you. So what you could easily do is simply just go long the equal amount over on the other side of the TQs. And at this point, if the market continues to rally, then your long TQs will make as much money as your short tech stocks made. Now, of course, same way, if the market does turn down and tech stocks crash and go down 1%, well, you're going to lose that on the other side. This is called hedging, and you can temporarily put on the brakes at any time during any trade. Now, the great thing about using this for hedging is that it's cheap. It's stock. It's really cheap. There's not a lot of commissions, and it's very clean because when you try to hedge with options, now you've got to worry about Vega and Theta and how that's going to affect all your trades. When you just couldn't go in and put on a hedge with a stock or this levered ETF, it's just a play on eliminating your delta exposure. And the great thing is you can take that off whenever you want very quickly in the market. Thanks for joining me for the session. Come join us for some of our other sessions. We've done an entire series on all of the levered ETFs. Goodbye, everyone.